We have with us now, joining in on the show, Rajesh Chervuu. He's the CIO of Validus Wealth. Rajesh, thank you so much for taking out time. Rajesh, for Indians, a popular port of call, and the first port of call is fixed deposits. Anything that gives you the return guaranteed and printed in black and white. However, the kind of situation that we are in right now, interest rates have of course fallen very, very significantly. And today, a one-year FD will barely yield you 5.5 to 6%. How can one make money? And I don't mean only by fixed deposits, by the entire universe of fixed income. How can one, maximize their returns from fixed income in today's day and age?
Thank you. Good evening. You are absolutely right. I think the yields have drifted significantly lower over last 3 years or so in a gradual manner. Seems this is becoming a new normal, and structurally, I think we are heading into a low interest rate regime altogether. For this, I think the structural change and the structural differentiation, whatever it has happened, that is RBI's stated objective of keeping inflation under check and positive real rates. This has led to this situation of, I think, subdued interest rates. In that context, investors need to keep hunting for yield enhancement strategies and opportunities from time to time. That is a new challenge investors are facing, especially in fixed income. That is a debt, whether it is a debt funds or FDs. Given the current situation, what we see, I think, what are the opportunities we come across is small savings schemes like NSE, PPF, MIS, KVP. They're offering reasonably, I think, relative to debt funds or FDs. They're offering a better, with a steady flows and safety. I think they're offering a better, they're attractive at this point of time. Investors with conservative approach and smaller corpuses, I think they could start with this small savings schemes to start with, given the current situation.
All right. It's become quite easy to do this as well, but liquid funds as a category was largely used by corporates or, very savvy HNIs to park their money temporarily because you get that extra yield from a liquid fund. And that would benefit corporates immensely, But now, thanks to, fintech, for retail investors as well, it's become extremely simple. With a click of a button, you can put your money from a savings account to a liquid fund, even for 1 week, 2 weeks, 3 weeks, and then bring it right back when you need to use it. But as per, Morningstar, liquid fund has given roughly 3% in the last 1 year. Even a savings account gives 4%. So how do you sort of look at liquid funds in such a situation? Do you think they're an efficient money management tool that retail investors can use?
Yeah, see, you're absolutely true in that sense. Overnight and liquid funds yields drifted downwards closer to 3% or sub 3% levels. So then that is the situation with most of the savings bank interest rates also. So corporates doesn't have much option or doesn't much actually choice in that sense. Whereas retail investors or individual investors can actually, instead of actually liquid funds or overnight funds, they can continue to look for alternative options like savings bank interest rates. But across the board, I think savings bank, whether it is industry average savings rate, is also closer to liquid fund rates. Then what should the investors be doing at this point of time? So I see prima facie, actually there are two pockets, two options investors have. One is have sweep facility to their savings bank account. That is one way of, because most of the individual investors, retail investors are using these liquid funds primarily for their STPs, etc. Systematic transfer plans, they are using it. Yeah. But unfortunately, I think the yields have significantly lower and stamp duty has also come in. So that is where I think the sweep-in facility with savings bank account, there is one option. The second option is new banks, which are offering more than industry average savings rate, that 100, 150 basis points higher interest rate. There's a 4.5% interest rates on an average. These newer banks are offering. Investors actually go with those banks for savings deposits. These are the two options I see it currently.
What about corporate FDs? We often see a lot of corporate FDs offering a better return than bank FDs. Of course, they come with their fair share of problems as well, as the depositors of DHFL and ILFS know too well. But when we look at a very reputed corporate FD, it offers an all too tempting proposition. So, what's your view on that?
Corporate FDs typically offer better rates than bank FDs in general. Even now also, that situation prevails. But what we suggest investors, I think investors who can understand the associated risks with those instruments and having appetite can go with these corporate bonds, because credit environment for last 2 years, as you have rightly put, since ILFS, that is 2018 onwards, credit environment continue to be is not conducive for investors, especially for smaller investors. I think they have to exercise extra caution. So within that, I think what they could do is, I think relatively they could go with certain secured lenders, like I think gold lending platforms, etc. Their FDs, etc. Basically, I think NBFCs which are into secured lending platforms. So those FDs, corporate FDs, investors could consider, but before doing corporate FDs, anyway, come with their set of actual risks. Investors should do adequate due diligence before getting into that space.
And corporate bond funds, meantime, I mean, that would sort of take away some of the risks that are associated with corporate FDs. Do you think that's a good bet?
Yeah, but if you look at the average YTMs of that category is also not so lucrative. Yeah, so I think that's also in the range of about 5.5 to 6 or 6.2%. So instead of that, I think your small savings, instruments itself are actually better. They are actually ranging between 6.1% till up to 7.1%. That is the corridor small saving instruments are available currently. So corporate bonds, yes, I think the safety, I think in terms of, I think the risks are actually being outsourced. I think managers are actually looking at those instruments very closely, but they are coming with at about 5.5 to 6% or 6.2% kind of YTMs. That is actually takes away some amount of attractiveness.
All right. So largely, if we have to sort of in the pecking order of the assets within the fixed income category, if you had to choose, how would you sort of recommend retail investors distribute their money? And also, to what extent should one consider one's tax bracket?
Tax bracket, I think I will take your second question first, then I will come to, I think, the pecking order later. So tax bracket is one important thing. Higher the actually tax rate do impact net required sight on that. The higher the tax bracket, lower net returns. That I think that is a kind of relationship. Investors with the higher tax brackets should look at bonds bonds which attract only capital gains. So typically there are like a zero coupon bonds or market linked debentures or deep discounted bonds. These kind of actually instruments will come with, I think, capital gains. They will not have any. They're better capital. They bring in certain amount of capital efficiency. So investors should be, I think, mindful of that. I think what kind of actually tax structure they are into and what is the tax incident of that particular instrument. And with respect to the pecking order of because that keep changing. This is an investment strategy. Investment strategy keep changing with market conditions and market environment. Given the current suboptimal or subdued interest rate times, investors, I think the attractiveness seems to, and the safety, credit environment, all these things, just if you put it into the perspective, the small saving instruments look quite interesting, quite attractive. So that is one part of it. Second thing is corporate FDs. Corporate FDs, again, in terms of pecking order, I think investors should go with, I think, more secured lenders or secured FDs compared to unsecured lending NBFC FDs, etc. So that's the kind of, I think, differentiation. And for everything, what is the suitability, whether they have that kind of risk appetite or not, investors, and they do they understand those instruments sufficiently or not? That's the most important thing before getting it.
So just before we move to queries, one quick question, Rajesh, and that is why fixed income investors should especially watch out for the budget. How would budget and the different announcements, the more macro in nature, could impact fixed income?
Yeah. So the budget is an important event, especially from fixed income market perspective, because what is the kind of budget deficit? So whatever tax collections versus expenditure government actually intend to put to spend. So whatever difference is there between their tax collection to the expenditure is a typical budget deficit. So what kind of budget deficit they intend to actually table in form of budget papers. And if you see in the last 5 years, average gross borrowing is at about 7 lakh crores. And addition to 7 lakh crores original budget due to pandemic, etc., they have borrowed additionally another 5 lakh crores or so. So this time around, what kind of actually budget deficit they actually envisage, and how they intend to fund it, and whether it's how much is short term, how much is long term, how much is the T-bills, how much is dated securities. So all these things matter. So that is one part. Second thing is there is another demand from states. States are asking government of India to give some amount of leeway for them to borrow more, given the current subdued growth conditions across the economy. So if they consider that particular demand, I think then the states could also do some amount of additional borrowing. So put together the consolidated deficit, budget deficit could be quite large. So what is that quantum? What is the size of that deficit? That matters a lot. So that will actually impact yields and overall debt, fixed income market sentiment across the yield curve and across the market segments actually get impacted with that. So that's where I think budget papers, one needs to look at these numbers, what kind of borrowing and what kind of a leeway they are actually likely to offer to state governments.
Okay, so the size of that fiscal deficit number will be key, and also what is the central and the state governments borrowing for how long time period. All of that could impact the yields and concomitantly debt funds as well. Okay, let's take on board some questions and queries we have received from our viewers. First up, we have Anand Bala, who says, I've been reading about how we are in for a prolonged rate pause in 2021. How will this impact fixed deposits, gilt funds and long duration debt funds? Kindly explain. I'm retired and have a major portion of my investments in these funds. Rajesh, valid question. However large the fiscal deficit size is, because we are in an exceptional situation created by COVID, it's unlikely that there are going to be any interest rate hikes, or at least of a sizable number, maybe in this year or for the most part of this year. So how would it impact the assets that Anand has mentioned?
Sure. So as he has rightly asked or rightly put, RBI is unlikely to actually we are getting into a prolonged rate pause kind of environment. RBI is now walking a tightrope. Although it has reiterated its growth focus and has maintained accommodative stance, high sticky inflation could force a rate pause for longer than expected and liquidity absorption measures. These things actually could limit the yields in marketplace. So debt funds and their returns likely to be quite subdued for a couple of quarters, at least, if not a couple of years, at least for next 12 to 18 months. We expect this environment is likely to persist. Hence, investors should look towards alternative options, alternative actually opportunities to fill in the gap in terms of, I think, whatever yield expectations or return expectations they must be having. So as I mentioned earlier, since he has also mentioned he's a retired person and he's looking. So for him, the small saving instruments would fit the bill in that sense.
Schemes, if Mr. Anand is eligible, the senior savings scheme is as well a great, scheme available from the government. It has tax benefits as well, and not to mention higher rate of return than your normal FDs. Okay, Mohit Gupta has written into us saying that I've invested a large amount in the ICICI Balanced Advantage Fund. It has a 47% net equity exposure. Now, with the buzz of the market falling, should one trim exposure? Okay, it would be interesting actually to understand if Mohit had a time horizon or an investment objective, but unfortunately, that's not there. So, is this the way really when one invests in a balanced advantage fund? Because a balanced advantage has a little bit of equity and debt. So should you be perturbed when either of the asset classes fall?
So as this particular category, balanced advantage fund, is typically a dynamic asset allocation. Okay, so every fund manager has their own factors, actually like certain variables like a PE based or PB based. So every manager has their own style of managing it. These are all dynamic asset allocation funds. So as he has rightly put, I think 47% is equity. I think time to time it can go to as low as about 20% to I think 100% equity. So this in this case, the managers are expected to act upon these allocation changes from time to time. Basis their asset class outlook. So investors doesn't need to actually bog down with whatever they're hearing in the market and whatever. So they don't need to withdraw. They don't need to actually do the redeem, or they don't need to reduce or increase. Manage, that is this particular class of funds. That is the manager's job to make these changes, dynamic asset allocation changes quite dynamically, use based on their frameworks, whatever they have built. So Mohit can actually stay put, and actually as long as the manager is delivering to his expectations.
Okay. All right. Well, on that note, I think we are now out of time, so we'll not be able to take any more questions. Rajesh, thank you so much for joining us today on ET Now and, helping our viewers out with their questions. And also, I think it was extremely important to make our viewers understand, especially since, almost all of them have investments in fixed income in some form or the other, as to how the budget could impact your money. The various nitty-gritties that the FM announces. They may sound very macro in nature, but they do have an impact on your money as well. We at ET Now will, of course, keep giving you all those detailed analysis. So don't go, this is your budget destination. Meanwhile, of course, keep sending your questions and queries in, whether it's with respect to your money, whether it's respect to the impact that the budget may have on your money. Send them in and we'll take them up. Our email address is themoneyshow@etnow.tv. It's the same address we'll use for the budget as well, so don't go anywhere.